Bloomberg Audio Studios. Podcasts, radio, news.
Merryn Talks Money listeners, here is a quick public service announcement before we get into today's conversation. Are you a Bloomberg subscriber? If you are not, you should be, and here is why. You will get ad-free episodes of this podcast and access to my Merryn Talks Money newsletter, as well as access to John's award-winning newsletter, Money Distilled. You'll also get access to subscriber-only events, such as the one that we will be hosting on March 17th. More details on that later this week, so be sure to sign up for your .com subscription so that you can join us. And of course, on top of all that, you will get unlimited access to Bloomberg.com and to the Bloomberg app, including exclusive stories and premium market tools. Subscribe now at Bloomberg.com/podcast offer. Welcome to Merryn Talks Your Money, the personal finance edition of Merryn Talks Money. In these bonus podcasts, we talk about the best strategies for making the most of your money. I'm Merryn Somerset Webb, and with me, senior reporter and Money Distilled author John Stepek, award-winning. Hi, John.
Hi, Merryn.
So, John, we are carrying on with answering a couple of questions that we have had in from readers, and this one is about REITs. It's from someone who says they are a long-term fan of the podcast. We like that. Thank you very much. Is there any chance we could have a program on REITs at some point? Unless I've missed it, I don't believe there has been one on the relative merits or disadvantages of REITs in quite some time. John, have we actually ever talked about REITs? I don't know if we have. We talked about investment trusts a lot, but I don't think we've ever gone deep into this little subsector of the market.
I don't think we have.
Subsector of the market.
Yeah.
Yeah, and as that suggests that neither of us have any deep expertise, we've invited on a guest. So today we are going to do a program on REITs. James is the name of the reader. Thank you very much. And we have invited into the studio to do with us a Bloomberg expert on this. This is Jack Sidders. Jack leads our coverage on all sorts of topics to do with investing, but in particular real estate. Jack, welcome to the London studio.
Thank you. I'll do my best to live up to that billing. I don't know. We shall see.
Look, when we say someone's an expert, they're an expert, and that's just that, okay?
Yeah. We'll let the listeners be the judge of that come the end of the podcast, I guess.
No, that's not how it works.
This is like fund manager stuff. Performance is relative. So you're definitely
particularly REIT fund managers.
Exactly. Being the expert is not the thing. It's just being more expert than me and John. Okay, so here we go. What actually is a real estate investment trust?
Okay, so the REIT regime, as it were, came into effect in the UK, and they have their own versions in most countries in Europe now, just around the time of the global financial crisis. And the idea was it was a sort of tax-efficient way for you and me, mom and pop investors in the Bloomberg parlance, to invest in real estate. So you're not getting that double taxation. And the deal was that these companies would return the vast majority of their earnings in the form of dividends. So they would have to have, most of their portfolio would be in what they would call the investment portfolio, so relatively boring long-term buildings with long leases that would generate steady rents. And then they would have a development portfolio, or some of them would have a development portfolio where they would do slightly riskier stuff, build out buildings, try and make some development profits. So they've been around in the UK for, what are we talking now, getting on, I guess?
Nearly 20 years,
nearly 20 years.
Yeah.
But
okay, so just go back a little bit. Just be absolutely clear. This is a listed investment vehicle which invests in property, in the main in a property rental business and also in development businesses.
Yeah,
so they
exactly.
have both parts to this, and then the tax efficient bit is that as long as they pay out 90% of the income they receive from their property every year, they don't have to pay corporation tax.
Yes.
So that's the tax efficient bit, right? So for an ordinary investor, it's simply a way of getting exposure to any particular type of real estate without worrying about tax or liquidity.
Yeah, and most of them were already publicly traded landlords before the REIT regime came in, and then they did all the things, ticked all the boxes that they needed to tick in order to convert to become a REIT, to get REIT status. And as you said, the whole idea is, if you're a retail investor and you want exposure to commercial real estate, but you don't have 100 million quid to go and buy an office building, then you can go and buy a share in one of these REITs, and that will give you commercial real estate like exposure. Albeit that then this is probably a whole other issue we'll get onto, that you're then exposing yourself to stock market volatility, which is very different from commercial real estate volatility. So that's an entirely separate issue. But so it's, you're getting exposure to the commercial real estate market, but it's maybe not quite the same as some of the ways that you could invest in commercial real estate through private funds.
Okay. And When we say that they invest in commercial real estate, there are actually a variety of different kind of REITs, right? So you've got some in residential property, some in commercial property, some in healthcare-related property, etc. There's a variety of different subsectors.
Yes, exactly. And again, to further complicate the picture, it always used to be the case that most of the REITs like to specialise. They were a London office landlord or they were a UK retail landlord. And the idea being that me as the investor, I want to make the decision about what type of real estate I'm allocating capital to, and then okay, I've decided I think London offices are the thing. I'm going to go and invest in what should be the best London office team who run this specialist London office REIT. Now, that's fine unless you happen to be, say, for example, a retail landlord in the middle of the retail apocalypse that unfolded between very loosely 2010 and the end of COVID, when, the rise of online shopping basically meant that all the retail landlords had just a torrid time, values collapsed. Understandably, quite a few of those management teams went, yeah, maybe we might need to pivot and diversify. And the big winners that you've seen over in fact, probably the period that REITs have been in existence in commercial real estate have been the kind of private equity real estate investors. And they are much more agnostic in terms of the types of real estate they will invest in. Talking like a Blackstone here, for example, they will invest in any type of commercial real estate depending on where they see there being structural advantages. So they can pivot and they can allocate, they will raise capital from investors with a mandate to put it where they think is best. So you started to see this evolution in the REIT market a bit, with some management teams going, oh, maybe we should do different things. Maybe originally we were an office REIT or retail REIT, but actually we think warehouses are a thing, so we should pivot into that. But that's an interesting sort of debate then between the managers and the shareholders, and what does the capital actually want? Do they want to make that capital allocation decision themselves, or are they trusting the management team to make it for them?
Yeah. Okay. And other areas that they could be in are of the data centers. There's quite a few self-storage ones, or there were anyway. So there's a whole group of different sectors they could be in.
Yes, yeah, exactly. Yeah. And in commercial real estate, if we were having this conversation 20 years ago, it would be like offices, retail would be the kind of twin aristocracies, and then maybe a little bit of warehouses. Now, retail obviously had its horror show, then offices, probably one of the more unloved sectors now because of COVID and more increased work from home, etc. And you've got, as you said, this huge diversity of subsectors. Data centers would be the really hot, sexy one. Student housing was a very niche strategy, now is a very established part of the market. Self-storage, healthcare increasingly. So yeah, a much, much greater variety.
All right, let's talk then about what makes these trusts perform or not perform, because some of them have had a pretty awful couple of years. And because they are listed vehicles, the share price can trade at a significant discount to the net asset value. And it definitely has been. As you say, retail has had a bad time. Student housing has had a horrible time for obvious reasons. And across the board, discounts have been quite high. What's been driving this?
If we just focus on the UK here, and I just checked the numbers, the UK REIT sector is currently trading at a discount of just under 20% across the board. This is according to EPRA, the European Public Real Estate Association. And that is a little bit worse than the historical average, although actually that's a bit better than it has been doing the last few years. The UK has obviously just been through one shock after another over the last 10 years, none of which has particularly helped sentiment towards publicly traded real estate. And as we touched on, different sectors have had their challenges at different times. So yeah, retail, terrible few years, then office. Then when interest rates blew out, almost everything was trading at a discount. I think there was one point where probably Unite, which was a student housing landlord, was maybe the only UK REIT that was trading at a premium. That's now gone because of the worries about student housing.
I think I wrote a very timely article on that. I'd like to remind everybody that when Unite were riding high, I did write an article going, I wouldn't do that if I were you. That was on one very rare occasion, right?
That was good timing. That was good timing.
Thank you, John.
It is one
Thank
of those markets that, it's well, like with a lot of real estate, it's vulnerable to, forces beyond its control. And right now, if you look at the discounts the different sectors are trading at, there's big variation. So office is very unloved. Residential is also quite unloved at the moment. But the warehouse landlords doing much better, much narrower discounts. And even at the risk of introducing even more jargon, you've got one called London Metric, who focuses on what we call triple net leases, where they've been doing quite well. They're a bit of a market darling.
Hang on, what is a triple net lease? You can't just introduce that and then move
basically,
on.
It's essentially that the tenant is responsible for a lot of the costs around things like dilapidation and so forth, so that there's no what the landlords would call leakage. They're very long term, they're very secure, and the rent typically only goes one way. But they're an interesting one, an interesting company, because they are, going back to our earlier conversation around that whole sort of sectoral allocation, they, way back in the day, before they were called London Metric, and the people that ran it were basically retail specialists, but their chief exec, Andrew Jones, saw the writing on the wall of what was coming for retail and made the big strategic decision to pivot towards industrial property, warehouses, given the rise of e-commerce, and that proved to be quite a prescient thing to do. And then they've also... So this speaks to a kind of much broader issue, to go back to your question about why are these companies trading at discounts. One of the reasons is lots of them are very small, and therefore proportionally they're very expensive to run, because whether you've got $1 billion or 10 billion or 100 billion, you basically need a fairly similar size management team. And actually that management team is not that big. I often think that of all the jobs you could do, running a FTSE 100 company, running a FTSE 100 landlord must be one of the easiest in terms of like headcount that you've got to manage. But anyway, they recognise that you need scale to get better cost ratios, and that is something that investors now really want. And also so you can leverage relationships with tenants and all that sort of thing. And so they have gone out and acquired a huge number of subscale peers and grown themselves. And what that's done is that's pushed them into bigger indices. They're now in the FTSE 100. That introduces new shareholders. But even then, you compare them to the US, and London Metric will be one of our bigger REITs. They're tiny compared to their US peers. Now, this stat is slightly stale, but I believe it's still true. Prologis, huge industrial landlord, warehouse landlord in the US, its market cap is bigger than the entire UK REIT sector combined. So when you are a UK REIT and you are going out on investor roadshows and you're going to the US and you're trying to get meetings and trying to get the ear of fund managers, and you've got a couple of billion in assets, they're looking at you going, A, you're really expensive to run. B, how much liquidity is there in your stock? And they're just not interested. So in order for the UK to get over a bit of this structural discount in what they're trading relative to the value of their assets, one of the things that they really need is scale. And as I say, London Metric is one of these companies that definitely seems to have got that message, and they've been on an absolute mission to acquire and to get bigger. So that's part of the answer as to why they've been trading at discounts.
Okay, so it's partly scale and lack of international attention as a result of that. It's partly interest rates, right? Because they pretty much always move with interest rates.
Very interest rate sensitive.
And why
because
is that?
Basically commercial real estate investors will always demand a premium over risk-free rates. So if government bonds are trading at 3, 4, then I want my commercial real estate to yield 6 or 7, say, this is very crude numbers, plucking them out of thin air, a healthy premium for the risk I'm taking. So when interest rate rise, the required yield on real estate rises. When the yield rises, the value falls, and equity market investors will straightforwardly, as interest rates start to rise, sell off real estate stocks because they anticipate them having to write down the value of their portfolios.
Yeah. Okay. So with interest rates likely to fall from here, that's a positive.
That should be
right?
a tailwind. So we should be entering a bit of a sweet spot for UK REITs right now, because basically, again, talking in very crude terms here, no one's really built very much for the last several years. It's particularly if you look at the London office market, for example. We had Brexit, which was big doubts about, are the banks all going to leave? Then we had COVID. Oh, okay, is anyone going to need an office anymore? And then we had interest rates going up and construction cost inflation going through the roof. So the development that I was planning to build that I thought would cost me X to build is now going to cost me X times 2 or 3. So the long and short of it is no one's built anything. What does that mean? There's hardly any new supply, and the tenants who are looking for offices at the moment, what do they want? They want the best new stuff that is going to lure staff back into the office, say, look, we're going to make you come into the office 4 days a week, but we're going to make sure it's a really nice office. And also we want to cut our carbon footprint as a business. What's an easy way to do that? If I'm a sort of knowledge-based business, I'll get myself a nice zero carbon office building. And there you go. I've ticked my box of slashing my carbon footprint. So all of which means London office rents should, and they are going up pretty rapidly, and they potentially will go up a lot more over the next couple of years. So you've got that as one potential tailwind. And this is true across a number of sectors, to be clear, not just offices. And then you've also, as you said, you've got the potential for the tailwind of interest rates coming down, which should be good for property yields and therefore valuations. So quite a rare dynamic of kind of both the numerator and the denominator going in landlords' favour. And yet we still haven't really seen generalist investors waking up to that and piling into REITs in the way that you might expect. And to talk to specialist real estate REIT investors and management teams and analysts over the last few years, there's just this deep resignation about when is the market going to wake up to us? When are we going to re-rate? What is the catalyst which is going to cause those discounts to narrow?
Would you expect a lot more, or a lot of corporate action in this sector as you have in a lot of the wider part of the investment trust industry?
Yes, we have already seen quite a lot. There has been a lot of consolidation over the last couple of years. I think initially that was a lot of private equity firms, Blackstone and the like, seeing the massive discounts these firms are trading at and going, yep, okay, I'll have some of that. I think the market is overly discounting those values. I can see rents are going to rise, and they wouldn't necessarily say this, but also I reckon interest rates are going to go lower and that'll help. So they've been taking them out at big premiums to their share price, but in lots of cases, discounts to their reported asset values with a view to then whether it's splitting them up and selling off the assets individually at book value and then creaming the difference, or whether it is scaling them into something else and who knows, potentially IPOing further down the line, although brave person to try and launch a big real estate IPO in the current climate for all the reasons we've just been discussing. But then actually more recently, and this goes back to what we were talking about with set companies like London Metric, we've actually seen many more peer-to-peer consolidation where you might be trading at a discount to your reported asset value, and I might be trading at a reported discount to my reported asset value. But actually, if we do an all paper deal, then that doesn't really matter. And so, yeah, we've seen a lot of consolidation there. In fact, we've had a couple of interesting takeover battles, one in the healthcare real estate space where you had KKR trying to buy a landlord, looking like they were going to, and then all of a sudden one of their peers came in and said, oh, actually, why don't we do it? And then you as the investors can remain invested and you get to participate in all the rental growth we think is coming down the line. Very closely run thing. And ultimately, the investors went with the sort of peer-to-peer deal rather than the take-private deal, which I think is quite interesting and maybe says something about tiny green shoots of optimism for the publicly listed real estate market.
I think it's a very interesting sector because going back to the interest rates point, one of the things I think is interesting, so from the point of view of interest rates rise, prices go down, so it's a bit like a bond, except it's not actually a bond because the rents mean that it's actually inflation protected. So what you really need to worry about is more a recession or their specific sector getting hammered. And I guess that's kind of one of the big questions at the moment is, okay, interest rates are coming down, inflation is probably just about under control, and then it's more just about, well, which sectors are going to survive in this particular economy.
Yeah, I mean, absolutely. The big risk is clearly a recession and potential credit risk in the tenant base, albeit that you look back to the global financial crisis and actually the number of landlords who really saw significant vacancy as a result of tenants going bust was relatively limited. Where I sit, and this is, I guess, coloured by having covered real estate for longer than I'd care to admit, but I guess immediately since the GFC, actually the thing that has destroyed the most value and driven the most value in real estate has been these kind of big structural changes in the way that we live and work and shop and consume, to the point around the rise of online shopping. Like if you were lucky enough to be a warehouse landlord over the last decade, you've just been a huge beneficiary without really having to do anything very clever. Just demand for warehouses has gone up a lot because people need to store stuff a lot more because they want to deliver it to your house instead of it being in a shop. You know, on the flip side, you could have been, in fact, I think I'm paraphrasing John Gray here from Blackstone, who basically said you could have, over the last decade, or I forget the exact time period, but you could have bought the world's worst warehouse and the world's best shopping centre, and you still would have been better off with the world's warehouse. So it's these big structural forces have been the things that I think have really moved the needle for these landlords. And then we thought maybe COVID would be that thing for offices. And certainly if you looked to the share prices of the office landlords, there was just a huge amount of bearishness. I think actually with the benefit of a few years on now, we see more people returning to work. We see more companies mandating that. And I think the death of the office, to be fair, also the death of the shopping centre never fully came to pass. It's just that demand is now concentrated in just a far smaller number of very high quality, very large shopping centres. Ultimately, people still want to go and try stuff on. You just don't need 500 of your shops across the UK to cover the UK, maybe you can do it with 50 in the 50 biggest shopping centres. But if you own one of those shopping centres right now, maybe you're in quite a good place. And actually, again, the retail landlords, having endured this like horrific period over the last couple of years, have actually done quite well relative to the wider peer group.
See, actually, just you saying there about big structural changes, the obvious question then, is there any angle from AI that you can see being something that might either be an opportunity or a threat for REITs?
Yeah, I mean,
the near
absolutely.
future?
Like data centers is obviously the clear play there. And so one of the things that we are seeing and have seen is, as I'm sure your listeners know, the big bottleneck for data centers is power. And so finding powered land is one warehouse landlord described it to me as like finding a lottery ticket. So let's say you were an owner of warehouses across the UK, and you're looking at your portfolio and you suddenly realize, actually, hang on a second, that site would work as a data center and it's got power. Maybe I can convert it to a data center. Suddenly the valuation is going to go to the moon, as they say. And so that's a process that a lot of landlords have been going through over the last couple of years to try and figure out. And now you are seeing a lot of the big industrial REITs, so companies like Segro, like Tritax, Big Rocks REIT, they now have meaningful, to be fair, Segro's had this for quite a while, but they now have meaningful parts of their portfolio that are in data centers. What I wonder, and could be the next leg of this, is does the public market value that differently to the warehouse bit, at which point I'm sure some enterprising investment banker will come along and say, I think you should spin out your data center business into a separate platform because that'll trade at a different multiple.
What about the consolidation? This is bad news.
So data centers are the big play there, although at the risk of being a bit of a belladonna, one of the questions I have around that to our previous conversation about structural shifts and is like these things are just massive stores of capex. The capex required is so huge. I've really struggled to get my head around it, having spent a career writing about property deals that I thought were big, which were a few $100 million, and these things are just like multi-billion. What happens when someone invents some new material that allows data to be stored or processed in a different way? And
and Jack, all the talk about moving the data centers to space and all that,
Exactly.
It seems short term that we will have these buildings.
And the demand, again, I reveal my ignorance here in terms of like the tech side of things, but as I understand it, where you want your data stored, if you're, for example, training a large language model, is very different to if you're doing something more consumer facing, because latency, like the delay, is less of an issue if you're doing it predominantly doing training. But then as soon as you're doing something like a search on Google or any other search engine, then the speed is of the essence a bit if you're thinking about high frequency trading and that kind of thing. But that has a huge impact on where you might want to locate your data center. Anyway, so obsolescence risk, I would say, just seems like this huge potential problem for data centers that could be one of those structural shifts that suddenly creates huge winners and huge losers. But I'm sure I'll be writing about that for years to come.
I'm sure you will, and we'll be talking about it. So, Jack, if there's someone looking at this sector now and going, look, it sounds great, Jack is incredibly compelling, I'd love to be in a REIT, where do they start? If you're looking at it right now, what's the most compelling part of the sector and the easiest way in, do you think?
So to our previous conversation around costs and liquidity, you probably look at some of the bigger names out there. And again, just focusing on the UK here, warehouses still doing pretty well, pretty solid rental growth, maybe a bit more mixed and a bit more patchy than it was around COVID, where we just saw this super, super strong demand and super strong rental growth. But broadly, I think most of the analysts still see that as a pretty positive area. Segro is the biggest UK REIT, and they are a European industrial landlord, but as I said, also with an increasingly interesting data center business as well. And Tritax Big Box REIT would be the other sort of big UK name there. Actually, Blackstone owns a big UK-focused warehouse landlord that they've branded Endurant, which you never know, could be a publicly traded company in the next few years. So those stocks are doing reasonably well. Over the last few years, the mantra had been beds and sheds. So sheds being commercial real estate parlance for warehouses, beds being the variety of different kind of living strategies. So whether that's rental housing, senior housing, student housing. Student housing, Unite would be the big player in the UK, but as we started at the top of the recording, student housing is definitely looking a bit less rosy than it has done over the last several years. I spent more of my career looking at London offices than anything else, and I have to say, yeah, I think the office market right now, the fundamentals are as good as I've ever seen them. Whether that translates to the public markets, reflecting that in share prices is another matter, because you've seen many times where the fundamentals look good, but the public markets have been focused on something else and it just hasn't translated. But if London offices are your thing, big players there, you've got specialists like Derwent and Great Portland Estates who purely do London offices, or what used to be the kind of, we would call the diversified majors, which thinking they're British Land in particular, and Land Securities is bigger, but they're moving away from London offices to some degree. But British Land, a big part of their business is London office campuses, as they call them, so big collections of London offices and shops all where they own the whole thing. But they also have a few other strategies as well, so they would be the way to play that.
I suppose the other good thing though about REITs is that even if the value doesn't get immediately recognised, they do tend to pay higher than average dividends.
Yes.
So you do get to, what is it, that horrible cliche, you get paid to wait.
Yeah.
So if you do think that it's fundamentally a good time and it just hasn't come about yet, then at least you're not kind of wasting your time particularly. Boo.
Yeah, I mean, the traditional thinking with REITs was that they should be really boring companies. They should just be solid, steady dividend payers. And in the US, in some ways, that's what a lot of them are. In the UK, because a lot of them were historically, they'd already were publicly traded real estate companies and then they converted to become REITs. Some of them had a kind of bit in their DNA, a bit more swashbuckling, like they liked doing a bit more development. And that was where some of the kind of super profits came from. For that, you've got to time the cycle and some of them are very good at that. But yeah, in theory, they should be really boring, sleepy companies that own income producing assets and hold them for a really long time. And yes, they'll tell you that they do lots of hard work to sweat them and manage them. Basically, just sitting on a big portfolio of income producing assets and paying it out in the form of dividends.
Okay.
I take it the sense that you think this is quite an easy job. I would like quite like that.
Yeah, well, nothing like a seasoned hack to be deeply cynical about the companies they cover. No, the real estate industry is full of lovely, charming people who are good enough to give their time and wisdom to ill-educated young reporters who are trying to learn about their market.
Perfect. John, anything else we need to ask, do you think?
No, I think that was great. That was very comprehensive.
Very comprehensive.
Probably much more information than anybody actually needed.
Thank you very much for coming on today. We really appreciate it. That was excellent.
Brilliant. Thank you so much for having me on.
Thanks for listening to this week's Merryn Talks Your Money. If you like our show, rate, review and subscribe wherever you listen to podcasts. Also, be sure to follow me and John on X or Twitter at MerrynSW and John_Stepek. This episode was produced by Samasadi and Moses and sound designed by Blake Maples and Aaron Casper. Questions and comments on this show and all our shows are always welcome. Our show email is merrynmoney@bloomberg.net.